Christiane Baumeister is the Robert Irene Bozzone Professor and Associate Chair at the University of Notre Dame. I don't have to introduce her very much because he's a very good friend of ours, and I'm very glad that she was able to join us today. And we are gonna again talk a bit more about expectation. And the floor is yours, Christiane. Thank you for coming, and we are looking forward to hear your presentation.
Thank you so much, Nicola, for the invitation. I'm glad to be here with you today. So let me start by sharing my screen. It's a pleasure to present this paper on measuring market expectations, which is a survey work that will actually appear in the first edition of the Handbook of Economic Expectations next year. So that already tells you expectations are important. In fact, expectations about future economic developments play a key role in an environment where people and policymakers need to take decisions under uncertainty, and they also form a key input into forward-looking models that we use in both macroeconomics and in finance. So just to give you an example, think of expectations about inflation that guide decisions about wage and price setting of firms, as well as the decisions of policy actions by the central bank. Expectations about commodity prices, for example, will affect decisions about investment in the extraction of resources and future production plans. So expectations are basically everywhere, and the question is, well, how can we measure them? Now, one very valuable source of information about expectations of agents about future macroeconomic outcomes are asset prices that are formed in financial markets and futures markets. And in fact, it is common practice that policymakers, private sector, and business people, as well as the financial press, basically take them at face value, which means that they treat the prices of futures and other financial instruments that we see quoted on a daily basis in the market as a measure of market expectations. Now, this practice is valid if financial markets are indeed efficient and rational, so that the expectations hypothesis holds. However, there is actually ample empirical evidence based on forecast efficiency regressions that shows that futures prices are not unbiased predictors of future spot prices. So the fact that there is predictability is an indication that you cannot really just read those prices of the quotations that that we observe in the markets. And one possible explanation for that is that market participants are actually risk averse, which means that they need to be compensated for taking on risk, for being exposed to systematic risk factors that cannot be diversified away. And that results in the fact that the asset price that we observe contains a time-varying risk premium. That means they are not directly equal to market expectations, but we basically have to disentangle the two components of which asset prices are composed. Now, to put that a bit more formally, asset pricing theory actually tells us that even in the case of risk aversion, the pricing of assets has to ensure that there are no profitable arbitrage opportunities, which implies this equilibrium pricing conditions where this MT plus H here is the pricing kernel or the stochastic discount factor, which prices any asset in the economy with a random payoff, accounting for variations in economic risk. And this term here is the random payoff on a futures contract when you take a long position, and ET here is the expectations operator based on time t information. Now, if you solve this pricing equation for the futures price, you end up with this expression here, which basically formally shows what I told you before, namely that the observed price for a futures contract at time t that matures h periods from today is the sum of the expected future spot price h periods from now plus this second term, which stands for the time varying risk premium. And so this risk premium can result from changes in economic risk that we experience or that we are exposed to over time, as well as the willingness of investors to bear those risks, which might also change over time given current circumstances. So as I said before, the challenge here is how to tell these two components apart, and empirically and econometrically, this is kind of demanding. In fact, the key question in empirical finance is, first of all, what determines the risk premium, and how to estimate it and get basically a quantitative sense of the size of the risk premium. Now, there are two broad classes of models that people have employed to answer that question and to come up with an estimate for that. The first class is are return regressions, which basically relate the ex post risk premium to observable proxies that allow us to capture risk factors for which investors demand compensation. And the second broad class are Gaussian affine term structure models, which by their very nature ensure the absence of arbitrage opportunities by imposing cross-equation restrictions. And they basically postulate that all the assets in the economy are determined by a small set of mostly latent factors. Now, the literature has treated these two modeling frameworks mainly separately. So either you go with the return regressions or the dynamic term structure models, but actually they are more related than you might think at first glance. In fact, they can both be cast into the following form here. as shown by Diane Singleton and Hamilton and Wu. So we're going to take a unifying perspective here on those two models to show that in essence they boil down to the same thing. So what do we have here? Well, on the left-hand side, we again have the payoff on a long position period futures contract, and that is a function of a set of risk pricing factors that can be either observed proxies or they can be latent. Now, in the return regressions, the coefficients here are basically just the OLS estimates that you get by running your regression of the payoff on a set of risk pricing factors. Whereas in term structure models, these coefficients are basically coming from the same set of underlying structural parameters, which can be summarized by these expressions here, where the two lambdas are the market prices of risk. And so the fact that they are tied to the underlying structural parameters is the way in which they are consistently that all contracts at different for different maturities are priced in the same way to ensure the absence of arbitrage. So just to put them side by side and think a little bit more about the different ways in which those modeling frameworks go about obtaining an estimate of the time-varying risk premium. So as I just said, return regressions basically do not enforce no arbitrage. They're simply based on unrestricted least squares estimations, whereas affine term structure models, by imposing the cross-equation restrictions, rule out arbitrage. Now, return regressions rely on measured variables, so that proxy the risk factors, where the risk factors, broadly speaking, fall into two categories. There are factors that are common across all asset classes and are thought to determine risk premia in various markets, while there are other risk factors that are more specific to a particular asset, so that only apply in a particular context of a particular futures market. Now, in the affine term structure models, the factors are most of the time unobserved and are inferred from the behavior of asset prices. Now, for the return regressions, the fact that we use observable proxies facilitates associating or pinpointing the sources of risk, because we know what a particular variable stands for, while in term structure models, the challenge is more with the interpretability of those factors, which is why sometimes they also are extended to include a set of observable determinants in order to assign some economic meaning and link them more explicitly with macroeconomic dynamics. Now, when it comes to obtaining an estimate for the risk premium, in the case of the return regressions, that is simply the fitted value that you obtain conditional on those OLS estimates, whereas in term structure models, the risk premium is obtained as the difference between the observed futures price and the rational expectation implied by the model. But as I said before, both model classes essentially are intimately related with the same structures, just a different way of modeling those. Now, what I want to do next is to provide an illustration of the type of risk factors that people have considered for the oil market, and then show how obtain market-based expectation measures based on that. Here is a pretty long list of variables that the key papers in this literature have considered as being important for the risk in the oil futures market. Here we see that the overall return of the market portfolio proxied, for example, by the CRISP equity index returns, or the S&P 500 stock price index, is one of the common factors. Then we also have a number of cyclical risk factors that pertain to the state of the economy. People have also used financial indicators of the business cycle, like the T-bill rate, the slope of the term structure, as well as indicators of the default probabilities in the economy, proxied by the junk bond premium or the default premium. There are also a number of oil price or oil market specific risk factors, which relate, for example, to the trading volume, to hedging pressure in the market, as well as more on the physical side, the accumulation of inventories. So as you can see, there is a long list of potential risk pricing factors that might influence the size of the risk premium here, and in various combinations, right? So as you might imagine, these different models will put quite different estimates of the time-varying risk premium, which will then imply a different set of underlying market expectations. So in addition to these return regression models here from the literature, we also consider a term structure model developed by Hamilton and Wu specifically for the oil market in order to obtain estimates for the time-varying risk premium. And so we end up with 25 different model specifications. And here is a plot that shows you the different risk premium estimates that we obtain from this set of models. And so, as you can see, in the early part of the sample, more or less up until 2005, there was broad agreement across those 25 models that the risk premium is relatively small, so ranging between -8 and $0. So by the way, a negative value here indicates that the price was here on average $5 higher than the price that was quoted on the market. Now, for this period, as you can see, it's also negative on average and actually relatively stable. Now, after 2005, instead, we observe quite a bit of heterogeneity in both the size and the magnitude of these risk premium estimates. In fact, at certain points in time, when the market is in turmoil, so for example, here in mid-2008 and again in mid-2014, we observe differences that can be as high as $55 in a given month between the different estimates here. So this obviously begs the question, well, how should we pick any one model among this set of models? So how should we choose the implied price expectations given this substantial heterogeneity? Because essentially mapping these risk premium estimates into market expectations about the future oil price will imply an equally dispersed set of expectation measures. And obviously they cannot all be representative of assessment about the future course of oil prices. So what we need is a way to select the most plausible estimate among those models. And so here, I draw on some work of mine where we proposed a selection criterion to identify the most reliable market-based expectation measure. So just to fix ideas, we obtain a set of expectations about the future spot price at horizon H by adjusting the observed futures price by the risk premium estimates that we obtained. So which were all those different lines on the previous graph. And then we simply apply insights from forecasting to select the most accurate price expectation measure. In fact, we're going to use the mean squared prediction error as the criterion to assess the accuracy of the various price expectations. And that's based on the key insight that the conditional expectation minimizes the mean squared prediction error under quadratic laws. And so that means that the most reliable market-based expectation measure should be the one that delivers the largest reduction in the mean squared prediction error. And this is actually a general methodology that does not only apply to the oil futures market, even though I will today show you results for the model selection for particular application, but you can use it to recover the unique market expectation for all financial and futures markets that you're interested in. So let's take a look at the results for the oil market here. So here I show you basically the ratio of the mean square prediction error of the implied price expectation relative to the mean square prediction error of the no change forecast. This is a convenient normalization because it allows us to implement statistical tests for the significance of the reduction in mean square prediction error. So a ratio below 1 here indicates that the model-based expectation outperforms the random walk, but our real benchmark here is actually the first line, which shows us the forecasting performance relative to the random walk of the unadjusted futures price, right? So what we want to know is, once we correct for the risk premium estimates, does the market-based expectation do better? And that's the criterion that allows us to rank the various models and to discriminate between the various risk premium estimates. So that means that any model, and here is the entire set of models considering different pricing factors. So any model that has an MSPE ratio that is greater than the unadjusted futures price is inadmissible. So that expectation measure should be discarded because it does not improve upon the performance of the unadjusted futures price. Maybe something that is noteworthy here is that for all the horizons, so this is monthly, the monthly horizon from 3, 6, 9, and 12 months ahead. So the futures price here outperforms the random walk and in a statistically significant way, and it performs better at longer horizons. Now, if we take a look at the implied price expectations, we see that there are quite a few models that outperform the random walk, but more importantly, that also do better than the unadjusted futures price. There are more models of that kind in the short run compared to the longer run. But what we really want to use that methodology for is to identify the one model that does best, because that will deliver the most accurate and most plausible expectation measure. And so these models are the ones identified in red here, which lead to the biggest reduction in mean square prediction error. So at the 3 months horizon, this is a model by Hong and Yogo, but it's actually very much tied with the term structure model of Hamilton and Wu. And that's important because for the remaining horizons, this term structure model is the clear winner among this set of models considered here. So the key takeaway here is that the Hamilton and Wu term structure model seems to be our preferred model to back out the risk premium and obtain a measure of the model implied market expectation. Now, what can we do with this result? Well, we can use that model to get the market expectation and then see how it performs, not just here in a statistical way on average over the sample period, but at specific points in time. And here for illustration, I show you basically the term structure of expectations together with the term structure of unadjusted futures prices in blue here, and then the ex post realized spot price for a selected set of dates. So we basically just start in June 2014 when the oil price decline happened, and then look at different points in time, which are all 18 months apart. So they were not picked for any particular reason, but it's just kind of like to zoom in and see what the risk adjustment accomplishes. And what you can basically see across these different points in time is that by adjusting for the risk premium, usually you get closer to the ex post realized spot price. So you're closing the gap between the unadjusted futures curve and the spot price path. Now, sometimes you close the gap more, sometimes the gap is still wide, but in general, you obtain an improvement in terms of having a improved expectation measure, which is in line with the statistical results that I showed you earlier. Now, the gap, however, indicates that the market continues to be surprised by certain events that happen over the expectation horizon. And that allows us to also use these expectations measures to construct market-based shock measures. And that's kind of important if you want to understand the determinants and the economic impact of oil price fluctuations. And so they should be of direct relevance to policy as well. So here we look at basically the difference between the realized oil price and what the market was expecting the price to be the months before. So here we're looking at monthly market-based oil price surprises starting from 1986 onward. And so what you can see here is that, for example, the market was surprised by the price increase in relation to the invasion of Kuwait in 1990. So the market expected a price increase, but the realized price was actually quite a bit higher, which resulted in this positive oil price surprise. Now, here, for example, in relation to the Great Recession, the market was surprised on the downside. Now, here over the 2014-16 period of the oil price decline, the market was kind of like continuously surprised on both the upside and the downside, and then so kind of like with expectations being somewhat slow to catch on to the development. So sometimes they were expecting reversals that did not happen in the magnitude as expected, or the price slowed down further or more than what was expected. Now, the largest surprise happened here at the end of the sample in relation to the COVID-19 pandemic, where oil prices tumbled beyond expectations of market participants. So they were considerably surprised by that. Now, from this little narrative that I gave you, you can see that the largest surprises here coincide with very well-known episodes of either political or economic turmoil, and that's not surprising because sort of these are the factors that also market participants would react to. But in order to tease out the pure expectational component, what I do is to basically take these oil price surprises and then regress them on fundamental oil supply and demand shocks obtained from structural vector order regressions that basically get at these kind of events that I mentioned to you before, in order to see really how big the pure expectational component in these surprises are. And here, for visibility, I just zoom into the 2003 to 2020 period. In the paper, we also have the expectation shocks for the earlier period. But so here you see, for example, again, in relation to the Great Recession, that the red lines here are again the full market surprise, which contains, however, the slowdown in economic activity in relation to the financial crisis, whereas the blue bars here are the pure expectational component, so after accounting for the fundamental shocks. And so you can see that actually throughout the sample, the expectational component is non-negligible. So that's an important source of the surprises on top of the more fundamental forces here. And so in order to better understand what that expectational component really measures, it would be useful to study the transmission of these expectational shocks to oil market variables or the macroeconomy, which should help us to get a better sense of the sources of this expectational shock. Now, the market-based expectation measure are also useful in a number of other applications. So they can be used, for example, to evaluate the empirical content of economic models. And they have been, the oil price expectations measures that I developed also in my earlier work have been used, for example, to test various hypotheses. For example, there's this paper by Pavlidis et al. That test for the presence of bubbles in oil markets using those expectations, market-based expectation measures, because that allows you to conduct the test without having to take a stand on the fundamental drivers of the formation of bubbles. Now, I have used a cross-section of commodity-related expectation measures also to assess the financialization hypothesis of commodity markets. So the insight here is that if the financialization leads to integration across markets, because we're arbitraging across different commodity markets, then we should find a perfect correlation between the risk premium estimates. However, that does not seem to be the case, so we could not find evidence for the financialization hypothesis. Now, expectations obviously are also key for economic agents to in the decision-making process, and in fact, they can be used in modeling things like vehicle purchases, where the future developments of oil and gasoline prices might influence the type of vehicle that a household wants to buy. Then future price expectations can also guide the decisions of whether to accumulate or draw down inventories, or they guide decisions about whether to invest in resource extraction. So there are all sorts of economic models where we might want to use an expectation measure to determine, well, to evaluate certain hypotheses or model decisions. Now, economic oil price expectations or other expectation measures form also an important input for policy analysis. That here are examples related to certain regulatory measures and governance. So, for example, knowing what the expected oil price is will help make decisions with regard to the management of the strategic petroleum reserves. So whether to release oil in order to influence the price. It can also be helpful to assess which policy instrument to implement. So, for example, whether price-based policy measures are more compatible with the steering, basically, the behavior of agents versus quantity-based measures when it comes to choices in investment in vehicles again. So basically, policies need to provide the correct incentives to influence the behavior of agents, and so it's also key to know whether they respond or whether they take actually future price expectations into account when making choices like which type of vehicle to purchase. Now, obviously, also for the economic outlook, price expectations matter. So you can, for example, feed the oil price expectations into macroeconomic projections that then inform policy decisions by the central bank in terms of, to what extent they might affect inflation and economic activity over the projection horizon. Now, one last application that I looked into this paper is what the implications are of these market-based measures for out of sample forecasting. So the question here is whether risk adjustment is also beneficial for obtaining out of sample forecasts of oil prices. And in some of my earlier work, it seemed that the preferred model here, which is the Hamilton and Wu term structure model, could provide a useful also to produce out of sample forecasts, but actually for the updated evaluation period here, this is not so clear cut. Well, maybe let me clarify at this point that the analysis that we conducted before in order to find the most plausible market-based measure is actually an in-sample exercise. So even though we're relying on forecasting tools, we use the entire information contained in the sample to basically obtain the expectations measures. When to conduct out-of-sample forecasting in a real-time environment, then we need to re-estimate the model at each point in time, only using information as it was available at that point in time. And so that's why the out-of-sample forecasting results here are different from basically the in-sample results that I showed you before. And in fact, here I show you the MSPE ratios that we obtain by recursively updating the sample in producing forecasts for the West Texas Intermediate oil price. So here again is the unadjusted futures price, which is of course the same because here we don't need to rely on any estimation. This is really just what we read off of the futures curve. Now here we have the Hamilton and Wu model, and as you see, while it achieves some gains in terms of out-of-sample forecasting performance from 6 months onward, they are not as strong as for the unadjusted futures price. And the reason is basically, that we need to re-estimate this model in a real-time fashion. Now, one special feature of the Hamilton-Wu model is that it is tailored to the way contracts are set up in the WTI market, where the contracts expire basically at the end of the 3rd week of the month. So that means that we obtain forecasts at that point in time with this model. However, we might be missing important information that happens still in the last week of the month, because the underlying idea here is that we always project the oil price forward as of the last day of the month. And that is what this last column here is about. So here we also account for the additional information that arrives in the last week of the month by augmenting the Hamilton and Wu forecast by daily price changes, and that kind of like accounting for this additional information leads to further improvements in the out-of-sample forecasting performance, but it's still not quite competitive with the unadjusted futures price. However, also the futures price by itself has not performed equally over time, so which again hints at this idea that risk premia are smaller or larger at different points in time, depending on the economic environment. So it might still be useful to incorporate this forecasting model into other, into kind of like a framework by means of forecast combinations. So that could be one useful way to go about this. Okay, so this is basically an illustration of how we can use asset prices or oil prices to futures prices, sorry, to obtain market-based measures. But as I said before, oil futures are just one possible market where we can apply this selection methodology to obtain market expectations, but there are many other markets. So let me just briefly provide you with two other illustrations here, where I want to emphasize the fact that it is important in designing the set of expectations measures from which to select the best one. Basically, it's important to account for specific features of each market. Now, for monetary policy expectations, the common measure that is used are federal funds futures. And here, Piazzesi and Swanson were the first to propose also to risk adjust those futures prices by taking essentially cyclical risk pricing factors into account. And they show that these risk-adjusted expectation measures also outperform the unadjusted futures. But they only considered like one particular type of risk pricing factor, so they didn't really explore the entire universe of that. Now, however, in order to measure monetary policy expectations, there are actually many other financial instruments available besides Fed funds futures that could be used to infer market-based expectations about the future course of monetary policy. And it's actually far from obvious to know a priori which instrument delivers the best market-based measure. Well, potential other instruments that are available are like treasury bills, euro-dollar deposits, commercial papers, and so on and so forth. And all these financial instruments differ in their characteristics, which means that investors will also demand different risk compensation based on those characteristics, right? So, and for example, Gurkenak, Sack, and Swanson, they look at the forecasting performance of a range of financial instruments to obtain measures for policy expectations, but they actually do not take risk premia into account. So, so in other words, this is an area that is still a bit underexplored, how to best obtain monetary policy expectations measures based on financial. Now, in recent there are obviously additional challenges that are specific to the setting of monetary policy, namely that the policy rate has been stuck at the zero lower bound for quite some time, and we're since the pandemic, we're back there again. So we need to basically entertain a different class of models, shadow rate models, in order to be able to recover market-based expectations embedded in the yield curve under the constraint of a zero lower bound. And other considerations in this part of the literature are that there are heterogeneous beliefs that can also influence the size and a variation of premium. There are a number of recent papers out there that exploit the cross-sectional information about individual investors' perceptions in order to get a more nuanced picture of or modeling approach to obtain a measure for policy expectations. Now, another interesting setting is inflation expectations. So here, the common approach is to obtain break-even inflation rates as the market-based expectation, which is defined as the difference between yields on nominal treasuries and inflation-protected treasuries. So a number of countries have introduced these inflation-protected treasury or protected financial instruments, and so the standard way is to just look at how different they are to obtain a measure of inflation expectations. However, a noteworthy feature here is that the two markets are different in a number of characteristics, most importantly in their liquidity. So we know the nominal treasury market is very liquid, whereas the inflation-protected treasuries are less liquid. They were initially when the instrument was first introduced, but also they might more easily dry up during periods of financial stress. So that means that in addition to the risk premium, we also need to account for changes in the liquidity premium if we want to use these two markets to derive measures of inflation expectations. So, and that's something that also has not been taken into account in a consistent way. There are a number of papers out there that show how one can account for the liquidity premium and that it matters, but there is no systematic comparison across models in terms of the implied inflation expectations measures. Now, what's interesting as well for inflation expectations is that we do not necessarily need a financial instrument that's linked to inflation in order to derive market-based measures of inflation expectations. In fact, even before the introduction of inflation-protected treasuries or inflation swaps, there were some ways were proposed to use still market prices to infer inflation expectations. So in fact, Jim Hamilton has a set of papers where they propose to model the joint dynamics of nominal interest rates and actual inflation in a state space model where the inflation and the real rates are treated as unobserved states. So you can use other market prices here, nominal bond yields, together with observed inflation in order to obtain an estimate here. Another approach that Jim proposed was also to use prices on agricultural commodities and exploit the relationship between commodity and consumer prices to obtain a market-based measure of overall inflation expectations. So this is kind of like just to give you an overview and a kind of like a little bit of a flavor of the different strands of the literature that have tried to obtain market-based expectations measures. But there is actually a long list of assets that is traded on financial forward and futures markets whose prices can be used to obtain expectation measures about key macroeconomic variables. And I think there is still a lot to be explored. For example, there are futures prices related to real estate, international shipping, foreign exchange, emission allowances, and others that really have not been used yet to back out in market-based expectations measures. And that could be very useful to look into those. And as I said before, the same type of methodology can be applied to select the most plausible expectation measure from a set of measures by applying these forecasting tools to rank the various models and obtain the best available measure. What is important in this context is to really be careful about the specific features that each market has and take them into account when deriving the relevant set of expectations from which to select the most reliable one. And of course, these expectation measures can be useful in many contexts for economic applications, but also to guide policy decisions. And that's basically it. Thank you so much.
Thank you, Christiane. We have a bit of time for a few questions. Let me start myself, because I find the paper really interesting. If you want, really interesting also because it's a bit destructive in some sense. Yeah, that when you see this measure of risk premium after the financial crisis, and therefore there is almost a structural change in the information content of this measure, especially the way using the regression part. And therefore the question that comes automatically is, how can we measure the robustness of the measure we are using to shocks like the one we are experiencing now, or in situation like emerging market, where we can expect this condition of uncertainty and shock to reflect very different in different indicator we use. And if there is something in the Hamilton and Wu approach that give the approach an advantage because overcome this obstacle of changing the implicit time varying information content of all different measure of risk we use. I don't know if I'm clear enough for what I'm asking, but I thought.
Yes, I mean, yeah, no, that's a very important consideration. So in fact, it is quite striking here, right? So how the implied risk premium measures get so dispersed, right? Now, in the case of commodities, the most likely explanation for this change in 2005 is actually the fact that commodities started to become a more important asset class for investors. So that's kind of like when there has been more interest more broadly to invest in commodities, whereas before they were more used for hedging purposes for I mean, investors that really had a physical exposure, right? So kind of like the composition of the traders in those markets has changed in 2005, which then results in this greater volatility and greater heterogeneity of risk premium measures, right? Now, it's an excellent question to kind of like try to understand sort of, I mean, what this is due to, or what kind of like an individual model, like the Hamilton-Wu term structure model, I mean, how they can reconcile that, or yeah, kind of like what explains these differences, right? So, but apart from sort of looking at what risk pricing factors we have in the return regressions, where we have the observed proxies, right? It's kind of like hard to draw a parallel or to attribute economic content to the term structure mods. I mean, that's something that I pointed out before, right? So one of the drawbacks there is that it's really harder to give an economic meaning to those factors, right? But so what we can see also by again looking at the model evaluation, I think, is that some models where we have clear observables and that kind of like perform similarly to the Hamilton and Wu model could give us some indication or some hint at what is driving that. But of course, the important other question that you raised is, of course, how do we deal basically with instabilities, right? So how to detect those and deal with them in a way. And I think that's a bit less clear cut. I mean, we can obviously the analysis and the selection procedure frequently to kind of like guard out against that to some extent. And in fact, I was quite happy that when I updated this to the more recent period, so the kind of like rankings seem to be preserved. So I didn't find major instabilities. So the original sample period when we did that stopped before 2014, and we know that since 2014 a lot has been going on with oil prices, right? So we had the 2014-16 decline. We now have all the turmoil as a result of COVID, and yeah, that kind of like gave me some comfort that the measure is or the selection is consistent with this data update. But it's of course important to keep monitoring these things, right? So I mean. And in a way, the time variation, even though it's based on kind of like this in-sample exercise, so where we, in a way, the relationship is postulated to be stable, but then the time variation is captured or picked up by the variation that we have in the risk factors themselves, right? So, but it's definitely an important point that we need to keep in mind.
Two questions. You have Rangan and Gideon again. Rangan, you go first.
Okay, thanks. Hi, Christiane. How are you?
Hi, Rangan. Good to see you.
Yeah, you know, primarily what I wanted to ask is that you use the mean square prediction error, no? So it basically treats the over prediction and the under prediction equally. So do you think maybe a different kind of a loss function might matter, because over prediction might be differently viewed than I mean, from an investor's perspective, no? So you might want to under predict than over predict, no? I mean, in terms of making your portfolio decision. So do you think that changing the that metric from mean squared prediction error to something that accounts for this asymmetry might play a different role in terms of the ranking of the models, or do you expect it to remain more or less the same? Because especially with the macro models, no, I mean, because they have business cycle factors then compared to the term structure model. So yeah, right. Basically.
Okay. Yeah. So I mean, I guess the loss function that you want to choose depends really on the purpose that you want to use it for, right? So here we want to use it as a selection device for the overall market-based assessment. And there, I mean, so the reason why we rely on the mean square prediction error is based on this insight here. So that the conditional expectation minimizes the mean square prediction error under quadratic laws. And here we are after a conditional expectations term, right? So here we're not taking an investor's perspective, but we want to basically get this market-based, this overall measure of expectations, and not sort of what an individual investor's expectation is for their portfolio choices, right? So in a way, the criterion that we chose is consistent with the purpose that we want to use it for, namely to find the conditional expectation, right? So what you're proposing is basically to do a selection of the risk pricing factors, but from an individual investor's perspective, right? So so yeah, I think that's I stop here.
No, I get it now. But just as a follow-up, so we do see that these expectations matter a lot, in terms of the oil shocks. Even, I mean, in some cases, much more compared to some of the, even when you account for the fundamentals, when you show that figure there. So, I mean, I mean, all these models of oil prices that we generally see is basically these fundamental oil shocks and their effect on economic activity and so on and so forth. But if these shocks are so big, I mean, the effects are likely to be, the multiplier effects are likely to be much bigger in terms of all the impact on the financial markets or the, I mean, the general economy. So how would you incorporate these expectations, say, in addition to those fundamental variables, and still, you see, the thing is identifying those expectation shocks within that standard VAR model, which identifies the fundamental shocks, whether based on sign restrictions or ordering or whatever, is how would you go about doing that, basically?
Well, so one way so I guess what you're asking is to have a consistent framework where you identify both the fundamental shocks and the expectation shocks, right? So one way, I mean, what I showed you here was basically kind of like a first step in that direction to sort of separate out the expectation shock from the surprises by orthogonalizing them with regard to the fundamental shocks. But alternatively, what you could do is to take the market-based expectation measure. So, and I mean, we have what you obtain at the end of the day is a time series of those expectations, right? So, I mean, I showed you kind of like snapshots here, but you have an entire time series. And so you could include that as an additional variable in your structural VAR, and then standard identification strategies in order to separate a shock to this expectation measure jointly with the fundamental drivers, and also see kind of like how the fundamental shocks would affect market expectations, and the expectation shock, how that would affect oil market fundamentals. So that would be one way, and there are different strategies in terms of identification that you could go about that. And in fact, what people have done in the VAR literature, or kind of like what you can use in analogy to what I just said, is basically that people have incorporated survey expectations into VAR models for the same purpose. In fact, in the paper, I cite a number of studies that have used then different identification strategies in combination with other macro fundamentals and survey expectations, and you could do the same thing also in I mean, you could adapt the oil market models in the same way.
Okay, thanks.
I think Nicola is still muted, but I'll carry on as he mentioned me first. Thank you, Christiane. This is always very interesting to watch people trying to forecast things, because I never do, because you never win. But what I noticed you mentioned in one of the final slides is this thing that it seems like all the models we use fundamentally are based on a representative agent type framework. So there is a market expectation. And you mentioned the dispersion around that. And I think, aren't we sort of underweighting the power of a specific model when we don't take into account that that model should perform poorly when expectations themselves are just more dispersed than when they are not? So when the market has a clear idea, we expect the model to work well, and then its predictions will be accurate. But the fact that basically the variance of your forecast error is constant and not a function of other things in the economy is part of this problem, that we underweight the value of a specific model against an alternative by not giving both the same fight against dispersion?
Yes. So was there something? I think someone else wanted to jump in the discussion, or no? So it was okay. Yeah, no, that's a very good point. I mean, I guess two things to that. So I guess your comment was in part related to the out of sample forecasting results that I showed, right? So
Exactly.
where here the issue is kind of like whether you want to rely on just one model consistently, right? Because as you just said, I mean, or as we know, the forecasting performance of individual models changes. It depends kind of like whether people are really using those models, trading on them, and so on and so forth, right? In order to hedge against this this possibility, people have used forecast combinations to account for this varying performance of any one individual models, right? And my suggestion here is, okay, so this model does not maybe perform on its own, but it might have valuable insights coming from the market that you might want to add to other models that kind of like are more based on time series modeling, or kind of like more atheoretical stuff, exploiting past patterns in the data, or so on and so forth, in order to hedge against that. Now, the other point that you made about the heterogeneity or disagreement of individual traders, that would certainly be valuable to take that into account, but at least in the oil market context, there is still very little information available that we could use in, I mean, that we could exploit for this purpose. I mean, there in the past couple of years, there has been an effort to conduct surveys by trade. So there's this Reuters Bloomberg survey of experts in commodities. Various central banks have started to gather information from the oil industry in terms of their expectations and stuff, but there is still not that much known about kind of like individual expectations by investors, in contrast to, for example, what I mentioned for the monetary policy expectations, right? So there's a much more active work going on to exploit really these heterogeneous beliefs in modeling also, or getting an estimate of overall market expectations, because there you have the luxury of cross-sectional information that you can exploit for this purpose. So I fully agree with you. It would be tremendously useful to have something like that also in the oil and commodity sphere, but unfortunately, we're not quite there yet.
So a quick follow-up, if you don't mind. So I don't know much about how the trades work in this market at all. In fact, I know nothing. But my idea always is to use something like bid-ask spreads. Don't they contain some information that one can exploit, especially on forward markets?
That could be one way to go about it. I guess I will not dive into a lengthy answer, because I think you guys need to move on with the next speaker.
Thank you very much, Christiane. Really, always a pleasure. It was a great paper, great contribution, and we as soon as the world reopen, or if the world allow people to come to South Africa, and soon we are waiting for you here. We are really looking forward to hosting you here. Thank you very much. Thank you very much for being at the workshop.
Well, thank you so much, Nicola.
Thank you.